I was 11, 12 years old in the late 70s. And so I actually can remember the stagflation and the malaise. The economic expectations and the inflation expectations creates kind of a stagflationary environment. Man, there's a lot of parallels to the current time.
Hello again, everyone, and welcome to another edition of Silver Bullion Television, SBTV. I'm your host, Patrick Vieira, part of the outreach team of Silver Bullion here in Singapore, where we want to help you truly secure your wealth. Craig Hemke, aka Turd Ferguson, joins us today. Craig was a licensed securities professional for nearly 20 years, disgruntled by the fraud known as financial services. He retired to a career as a serial entrepreneur back in 2008. Though otherworldly in his ability to forecast price movements, the turd is not a soothsayer, a psychic, or a witch. And after all these years, he simply has a decent understanding of the forces at play in the precious metals markets. And we're delighted to have Craig Hemke join us once again today. It's time to saddle up and silver up for Craig Hemke. Craig, welcome back to SBTV. How are you doing?
Patrick, nice to see you, my friend. I'm doing just fine, and looking forward to our visit. It's always fun.
All right, glad to have you back. You look great. So I'm hoping things are going well for you as always. But I'm going to have to start off with a lot of tension going on all over the world. Craig,
Yeah.
I know our hearts go out to all those affected and for what may be yet to come. But within this, I want to ask you, can you share your perspective on the relationship between geopolitical events and precious metals or precious metals price?
Well, there's a new factor in play. Usually it's just like a safe haven thing. And in my experience of watching gold for every day for the last 15 years, geopolitical things don't last. I mean, you'll get a spike, for a day or two, and then things will calm down, and momentum will stop, and the speculators that rush in and buy some COMEX contracts, and just as soon as they're like, oh, this is going nowhere, they go right back out. And so notoriously, those are fake outs. This situation is a little bit different, and gold is up. I don't know, from the open on Sunday the 8th to as we speak, it's probably up $100. And there's a couple of other factors. The geopolitic part of it has a little more staying power because of the uncertainty. I mean, we've been everybody's been idling on standby. The tanks have just been sitting there pointed at Gaza for the last 10 days, and nothing's happened yet as we record this. And so there's all this uncertainty that hasn't left the market yet. And so there hasn't been a reason for that geopolitical spike to reverse back out. Additionally, the current structure within the COMEX market, I'm referring to the Commitment of Traders report, is very bullishly positioned. It's the speculators, the hedge funds that are the short party primarily, and the banks are maybe a little more long than usual. And so that tends to support price as well. And then finally, though, the geopolitics is actually kind of bleeding over into rate hike expectations. We saw that last week as that right after the event in Israel and the attack and all that kind of stuff. The odds of a rate hike at the next FOMC meeting, which is in 2 weeks, or even the one in December, all of a sudden were plunging towards zero. And it made a lot of people start to think, maybe the Fed's done. And so, anyway, long answer. I'm good at that, especially this time of day, Patrick, because I've been drinking coffee all morning. Where you usually get a geopolitical thing and it's just boom, it's just that, and up you go, the sideways, then back down. This has different tentacles to it, which is keeping price elevated.
Right. Yeah, I agree. I think this time is quite a bit different in that there are so many hotspots, potential hotspots that are going on right now. Um, One other semi sort of a hotspot is is the price disparity that we're seeing with gold in the Western markets and the Eastern
Hmm.
markets. How do you reason this price difference going on between the two hemispheres?
Well, anytime Fabric kind of formulated in my mind how I want to direct this answer and try to make it get some cohesive sense out of it. Anytime you get any kind of price disparity in what is allegedly the same thing around the world, there should be arbitrage that develops, right? Especially in our all digital world where transactions can take place at the speed of light around the globe, right? There should be no variance of price in what is supposed to be the same thing. The fact that there is a variance is what we're getting at. Why is if gold for delivery in Shanghai is $100 higher per ounce than it is in London, well, why the hell isn't somebody buying it in London and selling it in Shanghai? Well, there's a lot of logistical issues on that, right? There's also let's see, if I take delivery in London, will they actually give it to me? And then I got to somehow, and so there are all those kind of factors like that are influencing why that arbitrage isn't being closed. I would also add, though, we've seen divergences in the last couple of years, even here in the Western markets, between the futures price and the spot price. I mean, even right now, hell, as we record this, it's the 19th of October. The front month for COMEX futures is a December contract, which goes off the board in about, I guess, 6 weeks. And there's about a $15, $18 spread between the COMEX December contract and the spot market. Why? I mean, I understand there's 6 weeks, but is that enough for that level of contango? And maybe you might remember, Patrick, back when COVID kicked in the months prior to that, man, the banks were just going to town abusing the exchange for physical system and playing the spread between spot and futures. And then when that all exploded with COVID, and there were these alleged logistical issues, flying, London bars around the world, that spread went to like $100 and stayed there for a long time before it gradually closed. And so, again, long answer, too much coffee. Why is arbitrage, why is global arbitrage not closing that gap between Shanghai and London or Shanghai and New York? And it's a number of factors like that. And then one other thing on top of it. I remember it's been 10 years since the Shanghai futures contracts? Is it about maybe 2014? Does that sound about right? I remember when that was developed, there was a lot of speculation at the time that was like a long-term plan to create a marketplace where if you sold crude oil for yuan and you didn't want to hold yuan and you wanted to immediately exchange yuan for gold, you could do it all through this central hub in Shanghai, that those markets were kind of linked. And so there might be a little something going on there too, that there's a reason why gold in Shanghai is perceived to be more valuable or worth the extra cost or something like that. So anyway, a lot of interesting factors, and it's definitely something that should be on, if you're following the precious metals, it's something that should be on your radar.
If you're enjoying this interview with Craig Hemke and I, please do consider subscribing to our YouTube channel. And to stay in touch a bit better, please do email me, patrick@silverbullion.com.sg, and join our emailer newsletter list where we will keep you up to date with new postings, things like promos, and more. Yeah, for sure. Craig, you think there's a chance where gold may actually, the price may be shifting where the price may be set within Asia?
Yeah, that's another thing that, gosh, Patrick, we've been talking about this for a decade too, that there are other hubs around the world, Dubai. Why doesn't India have, their own, why is India taking the price fed to them from London? That sort of thing. Moscow has developed their own gold price as well. For now, the pricing monopoly, if you will, is still kind of based in London out of what, tradition? Again, it's a little bit like the U.S. dollar reserve currency argument, Why is the U.S. dollar? Well, because it has been forever, and no one really remembers a time when it wasn't. And so, why do we still continue to price, the daily fixes in London and use that as a whole, a wholesale benchmark for the world? Well, just because that's what the world uses. There will come a time when that power will shift, for maybe a collection of reasons. But I don't think there's any reason why that shouldn't be the case. And it should also be a more physical-based market. We shouldn't be pricing the metal off of the trading of derivatives. And that might be a fun thing to talk about too, because this has been coming up a lot lately. Why is relative to, like, you've probably seen the charts, Patrick, of one of the biggest drivers or closest correlations of the gold price for decades has been real interest rates. And gold and real interest rates would kind of move up and down like this. Now all of a sudden there's this big yawning gap, and every couple of days or so I'll see things on Twitter where people are like, "What's going on? Why isn't gold $1,100?" Well, I think that gets to do with how gold is priced and the mechanics of the market. So anyway, eventually it'll move. That's inevitable. The pricing control, but for now it remains primarily based in London, New York.
Right. Yeah, I saw that chart you put out on Twitter or X, whatever they're X Twitter, whatever they're.
Yeah, I know. I can't call it X either. I'm having a hard time getting used to that.
Yeah, I saw that chart, and I think gold was down at about 1,200 or somewhere around there. The pricing for it, so that was
Yeah,
pretty different.
that's the thing. That there's a couple of things to First of all, and this has been something that has kind of bugged me for quite some time. The market computes real interest rates as the level of nominal rates, say the 10-year note, which is at 5%, versus inflation expectations, which over the 5 or 10-year period is like 3%. So therefore, oh, look, that's a 2% positive real yield. Not current. Does anybody really, when buying a 10-year fixed income investment, go, yeah, but I think inflation expectations are 3%, so I can assume a 2% after inflation return on this. I think most people look at it in the current time, and go, well, inflation right now, they tell me it's 3 or 4, but really it's more like 8, and so therefore, you know what I mean? And so that computation that the market uses for real interest rates bothers me anyway. But as an aside, real interest rates is historically, that's what gold is tracked. People say it's an inflation hedge, but that's only part of the picture. Inflation as it relates to nominal interest rates gives you the real interest rate, the inflation adjusted interest rate. And that's what gold has always followed. And so these charts that you'll see that you mentioned that go back 20 and 30 years, plotted gold and real interest rates together, and the correlation is like 95%. They're like this. Well, then all of a sudden, since about a year and a half ago, the correlation just broke. Now, had the correlation continued, it implies a COMEX gold price based on where real interest rates are of like $1,000 an ounce or 1,100, something like that. And I see these kind of traditional, quants out there. They're like, I don't understand. What's going on here? And they're just generalists. They just see a chart and a discorrelation, and they come up with, they pull all these reasons out of their rear end as to why they think that's happening. I'll tell you why it's happening. I wrote about this a couple weeks ago. Again, what do I know? I'm just a guy, but here's what I think. That this pricing scheme, the one that determines that gold price, is through trading of derivatives. My friend Ned Naylor Leyland famously said, it's the future's tail that wags the spot dog. Okay? And so you've got these derivatives that you trade in New York and in London, forward contracts or futures contracts. And the spot price follows the trading in that. Okay, these hyper leveraged and rehypothecated, gold accounts, and they trade off all these derivative products. Okay, For that, if you're going to discover price of a physical commodity that way, okay, rather than trading the actual physical, I say, hey, Patrick, here's an ounce of gold. What are you going to give me for it? And you say, I'll give you $2,000 for it. If you're going to actually price it based off, the trading of this, this empty whatever, nothing, right? Then you have to be able to deliver the physical commodity at that price, okay? Now, the way the precious metals markets are structured, the entities that are in charge of managing the physical inventory in London and to some extent whatever physical is in New York are what's called bullion banks, big 10 or 12 banks, okay? They are the ones that are in charge of managing the markets and flowing the metal. The fact that price hasn't gone down to 1,200, or see it in present, just watch the flows of the positioning. The fact that every time price dips, the banks get long and go long the contracts tells you they don't have the metal to deliver at 1,200. We have this record central bank demand, pretty solid retail demand. And these banks have to know that if they allow the computers and the hedge funds to take over and close that gap and drive the paper price down to $1,200, well, they've got to come up with metal to meet all of the physical demand that's going to follow at 1,600 and 1,500. And they have to know that, well, no, we don't have it. That break the system. And so the banks are on the other end buying while the speculators or hedge funds are shorting. And that prevents that price from falling all the way down and keeping that correlation. So it's really a function of physical demand, a lack of physical metal that has created that big yawning gap that is just so flustered the generalists that are like, I wonder why this is. Well, that's why. That's why.
Yeah, that's a great point, because if it ever gets that low, I think literally people will be backing up the truck for sure.
Right.
Craig,
Right. You could say, okay, well, it was that price 7 years ago. It was $1,100 an ounce. Well, yeah, there was no demand for gold. Very little back then. We didn't have the highest central bank demand in 50 years, back to back last couple of years, that sort of thing. So that's what's different, and that's why that correlation broke a year and a half ago, and that's why it's going to continue to remain, in this big yawning gap.
Speaking of demand, we're hearing over and over again how the silver is in such high demand, and the supply may not be able to keep up with this demand. Are you seeing the same thing? And if so, why aren't we really seeing that silver price needle move?
Well, it gets to the same point we just made. As silver has the same problem for the banks, poses the same problem for the banks. We saw 4 times last year in the fourth quarter where silver went down about 18 or 19, and the banks got heavily long. This is just COMEX positioning, and the speculators got short, and then boom, here comes a short squeeze, goes right back up. So one, to me, since that continues to happen this year, that precludes silver going to 12 or whatever. That's just not going to happen. But why isn't silver exploding? Why isn't silver, if gold's at all-time highs, why isn't silver at 50? And to me, that's how we got to get there. We got to get there through physical demand. Now, we ran a supply deficit last year. What did the Silver Institute say? Like 237 million ounces, something like that. We need that to continue. We need investment demand to continue. We need to keep soaking up what physical supply there is so that that ability to drive the price lower or the ability to keep the price at these levels begins to evaporate. For now, again, it's the same thing. If you trade the futures contracts, and as we record this, that's $23 an ounce. If there's enough metal in the vaults in London, New York, that the banks can physically deliver out and, metal at that price, then okay, well, then there you go. That's your price. What we need to get to is where there's not, like what we're seeing in gold. And that's where finally physical fundamentals take over. But for now, we continue to trade silver off of this derivative price. There are a handful of bank trading desks that kind of have a monopolistic control of that pricing scheme. They do it for great profit for their trading desks, and it keeps, you know, price in a box. I mean, we've been in this range now for what, 3.5 years? And if and when, I should say when, the time comes and we break out above 28, that may spur things along. But for now, that they just really have it, like I said, a real tight box.
Yeah, I'm looking at 28 as a sort of breakout number as
Yeah.
well.
Mm-hmm.
Got to get to
Mm-hmm.
25 first, though. It's having a rough time even smelling it. But I'll get back to all of this pain that we kind of see going on all over the place. And some of that is, of course, financial pain as well. And in the U.S., the recent University of Michigan's October Consumer Sentiment Survey showed Americans less optimistic about the economy's future than analysts had thought they would be. Craig, if people are less optimistic about the economy, is this another reason where we may see Powell start to loosen?
Yeah, that you remember Powell used to talk about. He was worried about deflation all the time, and how expectations of deflation lead to becomes kind of self-fulfilling, and then and it is, and now they worry about inflation, and the longer inflation sticks around, then people get it in their head that wow, and this is now a new paradigm that and it tends to be self-fulfilling. A lot of times economic expectations are the same way. I mean, if you think, oh man, this economy's headed south, and wow, that makes me worried about my job, and that sort of thing, then you start to draw in your spending, and maybe you don't plan that vacation or you don't buy that new car. And the thing kind of, again, on in mass, tends to be kind of self-fulfilling. So yeah, that's an important thing that I'm sure people like Jerry Powell are keeping an eye on. As they fact, because again, think of it as a lagging effect. Everybody talks about why are we not already in a recession? Well, the average length of time over the last Fed eight rate hike cycles, the average length of time between the first hike and the first real indicator that you're in a recession is 19 months. Well, we are, let's see, it was March. We are now 18 months. No, 20 months. Take that back into this rate hike cycle because it takes time. Mortgage rates in the U.S., as we record this, just hit 8% yesterday. So all these things kind of trickle through. And so those are the spinning dials and gauges that the Fed is trying to manage through the little, few tools that they have. So he's no doubt watching that. I don't think there's any question about it. But I think, Patrick, it bleeds into, I think, a bigger picture as you put all these things together. I'm kind of an old fart now. I'm 57 going on 58, which means I was 11, 12 years old in the late 70s. And so I actually can remember the stagflation, the whip inflation now of Jerry Ford, and the stagflation and the malaise, the foreign policy malaise, the economic malaise, the soaring interest rates, and all that stuff, the Carter years. It ain't identical, right? History doesn't identically repeat, but it rhymes. Man, there's a lot of parallels to the current time. Now, does that mean gold's going to go up ninefold? Hey, I'll take twofold after all these years. But there are certainly a lot of parallels. And I think most people my age can probably feel that too. And it kind of, again, the economic expectations and the inflation expectations creates kind of a stagflationary environment to go along with it. And that's what we had in the 70s.
Yeah, Craig, I'm not too distant from where you are at age wise. I remember that time as well. I mean, I can even remember times when it was Friday and my mom was like, "Hurry up, we got to get to the bank. We got to withdraw money for the weekend," because there
Yeah.
were no ATM machines even at that
Right.
time. So I hear you. I hear you. But let's say Paul starts to loosen. What message does it send? I mean, is the economy distant enough from inflation that a little loosening won't hurt anyone?
Yeah. We're about to find out. Um, because things are tightening. You've got geopolitics, which could just explode, right? Let's take a worst case scenario. Israel invades Gaza, Hamas comes down from the north. Israel says, Iran is sponsoring that. And they and some U.S. fighters start bombing Iran, and Iran says, well, to hell with this. We're going to shut down, we're going to mine the Strait of Hormuz. Crude oil is $200 a barrel. There's a scenario in there where the Fed, by next week at this time is issuing emergency rate cuts, right? So you don't know exactly, how this will play out and over what time. There are a lot of folks that I respect that are a lot smarter than me that think the Fed is higher for longer and they're going to keep rates at this level and they're going to take the balance sheet down and all that stuff. I fall back on two things. One, the paradigm changed in 2008 with the advent of quantitative easing. The Fed has shown now on 4 or 5 occasions since then that when push comes to shove, they will print and they will buy assets and try to keep the system solvent. And I just can't imagine that when the push comes to shove again, that's not what they're going to do. They're owned by their member banks. If the banks get in trouble, to hell with everybody else, they're going to do whatever it takes to keep the banking system alive. Okay, so, that's one part of it that, I don't know, some people think has changed or is going to change or whatever. I don't think so. The other part is, where the hell's the money going to come from? The U.S. is running $1.5 trillion deficits a year. And that's not going to change, right? We don't even have a debt ceiling at this point. They voted that. They said, the Congress is so selfish and arrogant. In their debt ceiling negotiation, they said, you know what? Let's not even have a debt ceiling until April or January 2025. There'll be a whole new Congress. There'll be a new president. It'll be their problem between now and then. Hell's bells. We'll do whatever we want. So that's not. Where's that cash going to come from? Interest servicing the existing debt is now nearly $1 trillion a year. That's only going to grow as the deficit and debt grows and interest rates remain high. So this idea that somehow the Fed is going to let rates go to 7% or something and then keep them there, it's just, I don't see where that's even common. But again, what do I know? I just don't think it happens. And so at some point, for me, what's going to happen is the Fed will kind of follow what they did in the 40s and 50s. They'll follow what the Japanese did. Over the last couple decades, they're going to institute yield curve control, which is basically a Fed put for the bond market that says, like the London gold pool, keeping gold at $35 an ounce, the Fed will say anytime the 10-year note yield gets over 3%, we are a buyer of treasuries. And they will cap the market at that level. That, Patrick, drives us back now to real interest rates where inflation maintains at 4% or 5%. The long-term, the 10-year treasury notes at 3%. Now we're talking -2%. That is even recognized by the markets. And then you can imagine where we go from there.
All right. Craig, I know you got to head out soon, but one last question here. If you don't mind sharing, what are the top maybe 1 or 2 things that are on your mind?
You mean like economically or politically or
Just Craig Hemke. What 1 or 2 things that are
Patrick?
on your mind?
Patrick, look at how I've gone on and on and on with like closed questions. And now you're going to ask me an open question? Well, we could be here for another half hour. All right. Well, first and foremost, I'm worried about in the present day, I'm worried about events in the Middle East spiraling out of control. And this deal where the headlines were that Israelis had bombed the hospital for about 6 hours. And people went crazy in the Middle East and Arabs that had migrated to, Europe and stuff like that. This is such an unknowable situation. You talk about the unknown unknowns of how this might play out. I think it's very concerning. And it's not, I might be thinking I'm safely ensconced here in the middle of the U.S. This can all impact me as well. You just don't know how this is all going to play out. And so that's the number one thing that I'm concerned about. Um, Domestically here in the U.S., I think we all remember how things went in 2020 between COVID and all of the race riots and and everything else that was shoved down our throat ahead of the last presidential election. Well, guess what? We have another one next year at this time. You think 2020 was bad? I suspect that the strife and the discord that defined 2020 is going to be several multiples worse next year. So I guess I'm answering your question as to, when I'm sitting around at night and I'm staring off in the distance and my wife says, "Where did you go? What is wrong with you?" Those are the things I'm mainly thinking about these days.
All right. Alrighty, Craig, Hemke, great info for all of us. That I thank you for sharing that. But before we head out, can you let us know how we can follow you on social media and the services you provide?
Well, at TF Metals is my Twitter X account. I don't know. I got 64,000 people. I think more than half, at least, are not robots. But anyway, so you can follow me there. I freely share stuff. I'm on there more than I should be. But I feel compelled, when I see stuff to share that with everybody that follows me there. So anyway, that's one thing. This website here, Patrick, it's almost, it'll be on November the 10th. It'll be 13 years that I've been doing this. And, there's no way I'm doing it for another 13, but I'll at least probably be doing it for a few more. There's value in it, maybe, I don't know, in the analysis I do every day. Fine. I hope so. People find that valuable. But man, at a time like this, when people are distant from their neighbors, a lot of people just spend time on screens and don't have a lot of human interaction. I think there's great value in my site just from the community kind of collegial aspect of it. There are people from around the world. We all recognize we're all screwed, right? We're all in the same boat economically and politically and everything. So there's no sense in arguing, red team good, blue team bad kind of crap. We're all just trying to help each other through the storm. So I post stuff every day, but within those posts, all the site members are interacting and posting stuff. You don't have to go searching, digging through a bunch of threads trying to find what people are talking about. So anyway, I think there's great value in my site, and then people tell me this. It's 15. I mean, it's not like I'm, trying to break the bank at $100 a month or something like it's some fancy dancy, charting newsletter. It's $15 a month, so it's 50 cents a day. But it gives, like I said, gives people an outlet where they can interact and talk to people that most likely see the world the same way and kind of prepare, and stay on top of things. So anyway, that's another long answer, but that's what you get at TF Metals Report. And all I can do is encourage people to check us out.
All right, appreciate that. And I agree about Twitter. I mean, I think your followers are probably all legit. My followers, however, they all seem to be ladies in bikinis, and never in my lifetime did I think I'd have to block women in bikinis. But nonetheless,
Well, no, don't get me wrong. There's some real value in some of those accounts. But I have some of those too. I'll look and I'll go, what?
all right. Craig Hemke, I want to thank you for your time, and I really hope we can do this again soon.
Anytime you'd like, Patrick. Always good to see you, my friend.
That was Craig Hemke sharing his views on the economy and gold and silver. To see more of Craig's work, please go to www.tfmetalsreport.com. If you like this video, please do subscribe, share it with friends, and give us a thumbs up. All are greatly appreciated. Audio-only versions of this interview can be found on iTunes and Spotify.